You've probably heard of the PE ratio, which is calculated by dividing the stock price by the earnings per share. But there's another important valuation metric that takes the PE ratio to the next level, and that's the PEG ratio. And it's really useful for figuring out whether a stock is undervalued or overvalued based on its growth rate. The PEG ratio is calculated by taking the PE ratio and dividing it by the annual EPS growth rate. For example, if a company has a PE ratio of 20 and an EPS growth rate of 25%, then the PEG ratio would be 0.8, which suggests that the stock is undervalued. If the PEG ratio is less than 1, it means that the stock is trading at a discount. On the other hand, if the PEG ratio is greater than 1, it means that the stock is overvalued. For example, if a company has a PE ratio of 40 and an EPS growth rate of 10%, then the PEG ratio would be 4.0, which suggests that the stock is overpriced relative to its growth. So when should you buy? Well, when the PEG ratio is less than 1, especially in high-growth sectors like tech, it can indicate that the stock is undervalued and potentially worth buying.